Hello folks, Steve Lentz here with the Morning Market Huddle, July 17th, 2008. Got some good stuff to talk about today. Presented material today is for educational purposes only and should not be construed as personalized financial advice. If you want to just watch and learn, that's great. Paper trade, that's fine. We can't tell you how much money to put on or whether to put on any money at all. Everyone's different. What we're doing here is educational, okay? Everyone has a playbook of trading. Okay, whether you trade stocks, futures, options, forex, or if you're an investor, you have a playbook of approaches that you use. Some of us have a very thick playbook, others very thin, organized, disorganized. But one strategy I want to go over today is called the credit spread. Now, to understand an options strategy, you need to understand what these risk graphs are telling you. All right, and what we have here is a graph showing you the stock price as Apple moves to the as Apple moves up, we move to the right here. As Apple moves down, we move to the left. Okay, that's the x-axis. The y-axis over here, we have a zero break-even line. Everything above the zero break-even line is gain. Everything below is loss. We intuitively know that if we buy 100 shares of Apple and it goes up in price, we're going to make some money. All right, if we own 100 shares and it goes up $10, we're going to make $1,000. If we own 100 shares and it drops $10, how much will we lose? Well, we're going to lose $1,000 right there, aren't we? So we really don't need this risk graph to tell us what a long stock position looks like. We really know that. Well, what about a complex options trade? All right, now here is what we call a credit spread. Apple's selling at 172.81. That was yesterday's closing price. If we went out of the money in the put option, say to the 155, let's say that you thought that Apple was not going to go below 155 and that in 31 days of trading on these options, it was going to stay above 155 and not go lower, you might want to sell this 155 put and bring in $3.69 per share. You could then go out and buy this 145 put to help cover that. If you did just this naked one lot by itself, your margin would be very, very high, and your yield on that margin would be very, very low. All right? And so one way that we get around this is by buying another option to help cover this short put. All right, we don't want to sell the short. We don't want to sell that put naked. Your broker will not like you. Okay, he will come to you and say, "Hey, we want all this margin money," and you're going, "Well, I'm only bringing in this amount." And what we do then is go out and buy this 145 put to help cover this thing. Now, the amount required out of your pocket is far, far less. Far, far less. And so we're going to buy one of these. We're going to collect a credit here. We're collecting $3.69. We're paying out $1.88. We're collecting $1.81. $3.69 minus $1.88. $1.81 per share is what we're collecting, and we get to keep it if the stock stays above 155. Okay, we get to keep all that amount if Apple stays above 155. So we're basically now an insurance. We are in the insurance business. You are a little one-person insurance company. Okay, you're coming in here and you're giving out insurance. You're selling insurance that Apple's not going to go below 155. Now, to reinsure yourself, you're buying this 145. That's the other way to think about this. Typically, we want to, in a credit spread, we want to sell high and buy low. We are selling this credit spread for $1.81. Now, watch what happens. Watch what happens with time. This same spread over in October, what's that spread worth in October? $8.25, okay, minus $5.45 is $2.80. So in October, that same spread is $2.80. In August, it's $1.81, okay. What is that same spread in July? 3 cents. Time by itself is going to erode that spread so that later we could buy it back for far less than what we sold it for. So we sell high and then buy low. Time is working for us here. Here's a picture of that credit spread. Okay, today's line is right here. In time, you could see that halfway between now and expiration, we're here in 16 days. By itself, time alone is going to give us a good profit. Then we make all our money at expiration there. Let's take a look at the markets real quick. Then we'll go to earnings a little bit here. View from the S&P press box. We can see that on the weekly chart, the S&P is making a nice little bullish tail there, combined with the MACD divergence. And the stochastics little tick up. We're looking at a possible bottom here. We are very much on the alert for a bottoming market. On the point and figure chart, we did have to draw in another little zero there. We're a little nervous about having to draw in another one. That would put us really then confirmed in a bear market after we break that bullish trend line. So we're a little nervous about that. Here's our earnings coming out. These are optionable stocks coming out with earnings either tonight after the market close or tomorrow before the market open. Here is the list that you can look at. You could just pause it right now, write some of these down. Most notably, we have Google, of course, coming out. Let's review Lufkin. Last session, we went over Lufkin and what happened with that. Look at this. Lufkin gapped up huge on its earnings. So what did that do to the calendar spread we were talking about? If you recall, we talked about a double calendar back on Tuesday. Had you put on a double calendar there, taking advantage of the much more expensive options in the front month than the back month, had you done that, your risk graph would have looked something like this. Okay? Very wide coverage of the bell curve of possible price outcomes here. In 4 days, you have some tremendous profit you can make. The problem is we know that Lufkin is going to move, and indeed it did. It went way up over there. So after earnings came out, this is an hour after earnings, after the open, after earnings came out, the implied volatility in the front month plummeted, of course. Look at this, the IV in the second month actually went up a tick or two, and that really benefited us here, and this really benefited us here as well. The question is, did the stock move too much for us to make money? And if you can look at this, here's our risk graph now. We're losing like $9. Not that bad right now. We're sitting quite pretty. We would want to have our stop fairly close. Certainly no more than 93 or so where we're really getting on the skids here. But if this thing goes down, look at the fat profit you can make. Nice, good yields, 50%, 75% if this thing goes down. So our reward to risk ratio here is very positive. Here's a little bullish play of the day. Northern Trust came out with a triple top breakout. That helped me go to this graph here and see that on strong volume on an earnings report, Northern Trust did, in fact, gap up and then shoot straight up. And it also broke a weekly trend line, which was coming off of a MACD divergence. All positive, bullish technical signals. If you were to put a trade on, you'd want to look at the options market. Implied volatility is very, very high. The options are priced very high. You could come out of the money here into the 65 puts and do a little credit spread here. Capture for every single lot you do, you're going to get about $60 for every 500 in margin required. Of course, you take 500 minus that credit to give you your net amount that your broker is going to want to see. Here's what it looks like in terms of a picture. So long as you got 30 days, 31 days, and it stays above that 65 mark, you're going to look real good. If it does go all the way down to 65, you'll lose a little bit more than what you could make, but boy, you got a real good probability here, 84% of making money. Not too bad. Folks, we're discoveroptions.com. We provide personal mentoring. We have the finest curriculum available for option traders wanting to become experts at this. You get private one-on-one sessions with veteran market makers who are going to help you develop a trading plan that makes sense. And we feature both non-directional and directional strategies. Take a look at our website, give us a call, or shoot me an email. Thank you.